Have you performed a Roth conversion in the early part of this year? Now, an early year Roth conversion can be a fantastic idea, especially with the market volatility we are currently seeing. But beware, it's easy to get tripped up by the taxes you are obligated to pay on an early year conversion. In this video today, I'm going to show you an incredible IRA hack that you can use as a get out of jail free card to save on tax penalties and more. Let's get into it. Now, before diving into this hack, it's important to lay some groundwork for this confusing world of paying Roth conversion taxes. The IRS operates under what's called a pay-as-you-go system. Essentially what this means is when you incur income, the IRS wants you to pay taxes at the same time that you incur that income. So in theory, if you perform a Roth conversion in January, the IRS expects you to pay the taxes on that conversion in a reasonable amount of time. Now, the question is, what is a reasonable amount of time? Well, the IRS operates under a quarterly time frame. So for taxes on income in January, the IRS expects you to pay the taxes by the end of the quarter's deadline, which would be April 15th. For quarter two, it would be June 15th, and so on. But here's where things get quite confusing. Not all tax payments are created equal. There's essentially two different ways that you can make tax payments. You can take withholdings from the given income, or you can make an estimated tax payment, and these are completely different in the eyes of the IRS. Now, a withholding is a tax payment from a distribution from your traditional IRA, your Roth IRA, or from a paycheck. And a withholding really breaks this mold of the pay-as-you-go system because it has preferred status. What I mean by this is when you make a tax withholding from a given distribution from your retirement accounts, it's treated as if you equally withheld that withholding throughout the entire year. So let's say that you're retired and you're implementing a $100,000 Roth conversion for the year. Now you split this up and you start the year with a $50,000 Roth conversion in January, and then because of some market volatility, let's say you layered on a second conversion in May. Now for this example, let's say that during these conversions, you didn't withhold anything. Now we would think that this breaks this pay-as-you-go rule. So will you owe tax penalties because of this? Well, if you make a distribution from your IRA in December and you withhold enough to cover your taxes for the entire year, then the answer is no, you won't owe any tax penalties. And this is because withholdings have a preferred status in the eyes of the IRS, and when you withhold for taxes, it's looked at as if you withheld equally throughout the entire year. But from past videos on our Safeguard Wealth Management YouTube channel, you know that paying taxes out of your savings account or taxable account is the optimal way to pay Roth conversion taxes. Well, unfortunately, you can't withhold taxes from a taxable account, and so instead you need to make what's called an estimated tax payment. Now, making an estimated tax payment is pretty straightforward. All you have to do is log into the IRS website and make the specified estimated tax payment. But here is where the simplicity of estimated tax payments ends. When making an estimated tax payment, you have to adhere to this pay-as-you-go principle. And so in the last example, showing $100,000 worth of conversions throughout the year, if you try to wait until the end of the year like you did with withholdings, you will have tax penalties. Waiting is not recommended. They expect you to take the entire year's worth of tax liability and at the very least split that up into equal payments in each given quarter. And so let's say that taxes were $20,000 for the year for that given conversion. You would have to split that equally at the very least and make $5,000 quarterly payments throughout the year. Now, there is something very important to note here. The IRS doesn't know when you actually perform a Roth conversion. When you receive your 1099-R at the end of the year, it doesn't specify the date you perform that given conversion. So if you're doing a Roth conversion in December and you pay the estimated tax payment to cover that conversion in December as well, you might be very surprised when the IRS informs you that you have a tax penalty. Well, wait a second. This doesn't make any sense. You paid taxes when you were supposed to. Yes, but the IRS doesn't necessarily know when you perform that conversion. You could have performed it in December, or you could have performed it in January. The IRS was expecting you to make equal tax payments throughout the year, not just in December. Not to worry though, you technically made your tax payments properly. You just need to prove this to the IRS by filling out Form 2210. This form will basically lay out and show the IRS when you have that given income and that you're following this pay-as-you-go principle. So a Roth conversion tax payment from a taxable account is certainly optimal, but it's also significantly more complex. What happens if you make a mistake, you miss a deadline, and you find yourself staring down a tax penalty? Well, good news for you, I have a get out of jail free card that you can use. Let's stick with the example we've been using, and you're planning on paying those Roth conversion taxes out of your savings. But you watched this video at the end of the year and realized that you messed up. You forgot to make any tax payments throughout the year. Here's what you can potentially do with this IRA hack. You can take a distribution at the end of the year and withhold everything you need to for taxes. Well, wait a second. Won't that distribution add to my taxable income? I don't want that. Yes, but we're not done yet. You then want to take the money in your savings and make a contribution back into your IRA equal to the distribution that you just took. We can do this by leveraging a rule called the 60-day rollover rule. If we replace that distribution within 60 days, it will be classified as a rollover, and it will be as if the distribution never happened. Because we paid for our taxes via a withholding rather than an estimated tax payment, we are covered. Remember, withholdings have a preferred tax status. So we basically avoid the penalty, and effectively we pay the taxes out of our taxable account. Our IRA balance didn't change from that tax payment. Now, this is an incredible get out of jail free card, but I'd recommend using it with caution and don't get in the habit of using it each and every year. There are some important details that you'll want to know that can ruin this strategy. The first is that you can only do a 60-day rollover once every 12-month period. And so this is not something that you can use each and every year based on the timing of when you would pay those Roth conversion taxes. Now, hopefully this doesn't scare you away from Roth conversions earlier in the year. It definitely shouldn't, because sometimes a Roth conversion earlier in the year can be the absolute best time to perform a conversion. Why? Because Roth conversions can oftentimes be on sale earlier in the year. Click on this video where we explain how you can gain a discount on a Roth conversion based on what's happening in financial markets. Always remember, you don't need more money, you need a better plan. Thanks for watching.